The landscape of virtual banks in Asia is quite diverse and dynamic. But broadly speaking, you have three groups. The front runners are Hong Kong and China. They're quite advanced. Some of the virtual banks are already operational and active since a few years. Then you have a second group, Malaysia and Singapore, where regulations have been drafted, but banks are still being set up. And then you have a third group, Thailand and Indonesia, for example. Regulations have already been drafted, but they have not actually been operational. LexisNexis Resolutions work with some of the virtual banks in the region. The key lessons and takeaway while working with virtual banks in Asia, virtual banks tend not to take fraud seriously at first until they hit with actual fraud losses and regulators are showing their concern. Secondly, is that the financial performances of some of the virtual banks are quite mixed. Some are profitable, but the rest is not. And virtual banks are also subject to similar regulations as conventional banks. And during the stabilization period, the regulators are paying close attention to their operations. Improving risk management capability for virtual banks are quite challenging. Building out their robust risk and control framework can be a challenge for any bank. Related to that is, of course, embedding fraud technology within the customer journey. By the time that they onboard new customers, authenticating users, and of course when customers make payments and money transfer. We work with many of the organizations in the region to deploy our fraud solution, ThreatMetrix and Emailage, and we help organizations combat fraud in various forms. Virtual banks are viewed as a result of the digitization process in the banking industry. They have to rethink about how they actually remodel their customer journey. For example, virtual banks don't have any physical branches. They do have a headquarters, but they don't have physical branches and outlets. All the interaction is now virtual, so customers are being interacted with, engaged with through emails, phone, etc., and online. So that creates a footprint, a digital footprint, as well as a digital identity for the customers. Without seeing the customers face-to-face, the risk for virtual banks have increased exponentially. As virtual banks are digitizing their operations, so have criminals and fraudsters. This development require virtual banks to re-examine how they actually screen customers. For example, the onboarding process happens virtually, so you require a strong and robust KYC and CDD processes. KYC stands for Know Your Customer, and CDD, Customer Due Diligence. To onboard new customers, virtual banks need access to extensive digital data network to properly screen customers and assess their risk scores. Also, it's important to make the distinction between interaction with bots and humans, because fraudsters are using remote access control tools to gain access to customer accounts. And of course, criminal and fraud syndicates are constantly finding new ways to take over accounts from customers, because that's a quicker way to commit fraud than going through the front door of the bank, in this case, hacking. Managing risk for virtual bank is a top priority. Fraud losses could damage reputation. Regulators could impose a fine, and that has repercussions in terms of loss of customers and loss of customer confidence. Combating fraud in a digital world will require a different approach. Criminals leave a trail of data fragments along the way, and this is where technology can show true benefit in fraud prevention.